How's it going?
Great. I'm doing
Good
great.
to be back out in the real world.
It's nice to be out in public. It's nice to see people and not have a mask on, at least between us, socially distanced.
Yeah, we do have the gap between us.
We do.
Yeah. So where have you been since lockdown? Were you in New York or London?
Yeah. I spent a little bit of time in New York. My travel schedule used to be sort of every other week or so.
I know. I can remember you
forth.
constantly bouncing back and
Yeah,
forth.
but over the last since zombie apocalypse started, I think I'd only been back 2 times maybe. And so I've been here mostly, stuck in the basement of my house.
Nice change.
Nice.
Well,
yeah.
kind of a nice change, but for a bit, and then
it's nice. My kids are at home. They've seen me, so that's important. It's been good. It's been good to be back and spend some quality time. I mean, really, it has been nice to spend quality time with the kids.
I think most people have
yeah, I mean, that's been something.
Enjoyed that bit.
Yeah, unexpected to come out of it. Not unexpected that I would enjoy time with my children, but just it was an unexpected sort of good consequence of being locked up. Was able to be
definitely.
home. Yeah,
especially in those early days of spring, summer when it was just glorious. Like we had kind of school holidays. Working from home.
It was great, and I've realized that maths for 11-year-olds, it's already sort of slightly beyond my.
Your fractions have improved this year.
They have, and my Latin skills that I haven't honed since I was 11 years old now have had to come back.
Nice.
Yeah.
QED.
Yeah.
See, that's
Sorry,
what
what's that? Yeah.
So. How's it changed? I mean, you're running the EisnerAmper. Sorry, I'll take that again. You're running EisnerAmper here in the UK. How's that changed? Yeah. Working from home. There's a team here. What's been going on?
So, like I said, I've been back and forth, and my role's really it's a global role, looking after asset management for the firm, and we're an accounting firm, so it's consulting, it's audit, it's tax, all that kind of stuff, and I'm based here, and I run the UK firm as well. And we've got a team, and the team has been working from home, and we're lucky. We had a pretty good setup going into this that allowed for remote working pretty well. And to be honest, given the kind of work that we do, it's something that works relatively well remotely too. And so it was great. Everybody's been happy and comfortable, though I haven't really seen my team in person very much, but we do regular catch-up calls, and I think that's true for a lot of people. In our space, we all learned to do calls.
Most
and keep
people
in touch.
adapted pretty quickly, didn't they?
Yeah, and it's interesting. A lot of the infrastructure spend, I think, that was happening for the last few years anyway, where there was some anticipation that increasingly people would be working from home. That was money well spent, and those people who had done that were able to push forward and run their businesses that way. And so we similarly had done a good job with that, so we've been working well.
So in terms of the actual service you've been providing to clients, has that changed much, or has it been that the clients are already prepped for this kind of situation, the off-sites and that kind of thing?
I mean, look, the work that we do, when you look at accounting, audit, tax, and even the consulting work we do, it's work that tends to be done remotely, and people need tax returns, whether or not we're in a pandemic. It's taxes anyway.
Quite literally death and taxes.
Yeah, and so and taxes continue apace, and so we're helping clients with that.
What about on the consultancy side? Has that changed flavor at all this year? Has it been the same?
A lot of the consultancy that we would do is sort of around infrastructure and outsourced operations and finance functions and things like that, and increasingly, given the drive to cut costs, I think we've seen an uptick in that kind of in requests for that kind of work and review of structures, of fund managers, how they're doing things and what they how they want to run their business, right? Because margins were shrinking anyway in the fund management space. You compound that with everything that's happened over the last year, and people are really trying to make sure that they can cut down on their costs, and one way to do that is outsourcing, and so we've been helping clients with that. So that consulting work continues, and then it's the regular kind of the stuff that we don't necessarily charge for, which is just general what's happening in the market and the business, and how do we raise money in an environment like this, and those kinds of things.
So that's actually a perfect question. What do you think's been?
That was too much of a softball.
It was a massive softball.
Yeah.
Just lobbed that one into me.
Uh-huh.
I'm going to swing and miss. What do you think aside from the obvious COVID theme of the year, if we put that to one side, what's the major trend of the hedge fund world or the alternatives world this year? I mean, whether it's how do we raise money in this current situation? Is it fees? Is it offshore changes?
It's all of it, right? Fees, but fees had been a running issue. So starting on fees, that's been a running issue for the last couple of years anyway, and in alternatives, alignment of interest between fund managers and investors, and there's been a real change, call it over the last 5 years or so, to make sure the fund managers are really, really, there's no better way to put it, that they're aligning their interests with the interests of their investors. And so that's continued. That said, I think that there's still compression of fees that's been happening, increasing over the last 8 months or so, through this crisis, and that's been tough on fund managers, and that's what's been driving some of these infrastructural changes to the outsourcing, that kind of thing. But fees are tough, and I was listening to somebody speak yesterday at on a Zoom conference, and they said their guess was was the average fee. The average fees were down to sort of 1 in 15 or so now, in the hedge fund space anyway. Mm-hmm. And so it's hard to imagine that you're going to get you're going to completely lose the performance aspect of the fees, but the management fees and the changes there, that's we're now pretty regularly seeing the management side fees at just what are the expenses of the business, and those are the fees you're allowed to charge, full stop, rather than assigning a value to it. It's what are those expenses, and we'll pay for those.
Interesting. And then the outsourcing element of that kicks directly into the cost of those fees.
Yeah. So fee compression, and then raising money, right? I mean, raising money is a challenge in the best of times. And when this started, I think there was to some degree a wholesale stop on fundraising. Investors said, what, we can't, particularly for new managers, right? Because how do you invest with somebody without really going and meeting with them and sitting across the table? It's possible to do it, and I think increasingly we've gotten more comfortable with that conceptually.
It's getting there. We're seeing some people raise, but it's not.
But it's just now starting, and so if you look at the beginning of the pandemic and how it happened, the money was flowing to the extent new money was flowing in, or say pension funds and adding additional allocation. They were doing it with GPs that they knew already, maybe had already invested in, and to some degree it was the big getting bigger still. So it was really tough, I think, for younger managers, for newer managers, and we were asked to help with due diligence a few times over the pandemic when, for example, U.S. investors that were looking to invest in fund managers sitting in the UK, they couldn't come over and have a look, and they said, well, you have people on the ground, can you guys go do it for us?
Really?
And
fully outsourced DD as well.
Fully outsourced DD, and I mean, and we can, but I think even for us, when you weren't really allowed out of the house, it was it was a challenge to do that kind of thing. So, but like I said, I think now increasingly you're seeing people able to do diligence and new managers, money's flowing back in, because ultimately I think what people realize is that new managers often have some of the best performance anyway. And so you really want to have access to that. You want to make those investments.
Yeah. That's the always been something that I think lots of people have realised, but not everyone's jumped on, is that the alpha in that manager who's managing a couple of $100 million kind of thing is they're hidden gems. Mm-hmm. We try and focus a lot on the emerging manager side of things, because there's fun stuff there too.
Oh yeah, there's great stuff in the emerging
dynamism
manager,
and they can fit into gaps that other people can't fit into.
And and they're really there's some great new niche products and geographies, and I'll lob another one in, which is there are certain strategies that have done really well over the last out of the last bit as well. You can ask me that question now if you want, or I can just I can answer my own question.
What are your favourite strategies of the year? What do you see? What's been going well?
Well, look, this is not this isn't sort of anything terribly revelatory, but certainly anything tech-related and healthcare-related from an equity perspective has done phenomenally well over the course of the year, and for those investors who are able to ride that with fund managers in that sector focus, have done pretty well on the back of that, and frankly I'd expect that to continue with both through the course of the next year. Where those managers with a heavy focus on tech and healthcare, life science, that kind of thing, I expect.
We've seen that a lot in the family office space as well. The
direct investment
into both those bits.
Yeah.
So I think you're looking at full spectrum, right down from the startup all the way to post IPO tech and healthcare.
Yeah, and I think that the direct stuff and the co-investment from family offices, increasingly from pensions and sovereigns as well. There's a lot of call for that stuff, and that I think is really interesting, because this gets back to the conversation we were having before about fees, and there's a very different fee structure when it's a co-investment vehicle, a fund of one, or something along those lines. Mm-hmm. But for the investor, it presents a great opportunity, and for fund managers, it's lower fees. But it's it's the relationship that they'll have with that particular investor, and we work with there's a large fund manager in New York I'm thinking of now, who the pipeline they have of these funds of one or co-investment vehicles is huge, and it's from one or two very big U.S. pension fund investors, and they've had such great success in identifying these singular opportunities for investment that that they keep coming back for more, and so I think for investors it's a great opportunity. I think for fund managers it certainly keeps the lights on, but it engenders some loyalty as well from the investors, and and look, it's not bad business. It's just it's not the 2 and 20 that we once had.
I remember I had this conversation with you and actually with Max Hilton at Peregrine a couple of years ago, talking about the bifurcation of the fund space, when you've got the funds that are slightly more institutionally built, institutional ready, and there's not much volatility in there, and they're aiming at that 7-8%, and then you've got the other guys who are a bit more sex and violence, who are a bit more dynamic and fitting into those gaps. Some of those smaller, fund of one, maximum 100 million, 200 million kind of thing. They're, I think they're the ones you're talking about. The fees on those guys seem to be able to stick a bit higher up towards 2 and 20, or they did at least, because they're really specialist, and they're kind of they're finding the diamond in the rough. Is that still ringing true this year?
I mean, you look, if you've got some really niche opportunity, you can charge whatever fees you want for it. But I think for for the most part, fund managers are just looking for steady streams of income in decent product for funds of one and for these co-investment opportunities, and so it's almost like it's an entry point into the firm, doing those kinds of things, co-investment particularly. I think that's where you can get to know a fund manager as well. It's an easier thing to do, and you due diligence a singular investment, and so that's good. Sure, if there are certain specialist opportunities that an investor wants to get a look in at, then you may have to pay up for that. It's true anywhere.
Do you get many family offices coming to you for structuring of those kind of things? Does that
It's to be frank, the structuring of those opportunities isn't necessarily that complicated, and fund managers are pretty well set up to sort of work with those, and we help, we sort of help on the back end of those, because they'll all need, it's taxes and audits done and those kinds of things, and so we're sort of there to help. The deals themselves get papered by the lawyers, and it is relatively straightforward to do those kinds of things, and frankly, I think you were just saying this before, but I think this is going to be the way. That's the way. That reminds me of The Mandalorian. This is the way. Sorry. Anyway, it's Disney. Children.
I'm a fan.
Okay, good. And I do think that's the way forward for a lot of fund managers, and so yeah.
So going back to the, we were talking earlier about. Completely blanking now.
Mandalorian?
Outsourcing. No, not Mandalorian.
I'm stuck on Mandalorian. I don't know. Actually, it's Friday. The new episode's out tonight.
So I've been listening a lot to podcasts a lot through lockdown, and one of the ones I've been listening to is the two guys from Scrubs. Do you remember that show, Scrubs?
Yeah, sure.
They've been doing a podcast throughout the whole thing, which has been my
about Mandalorian.
No, ostensibly it's about Scrubs. They watch an episode and then
I did hear about that. Yeah,
it's very silly, like any. They talk about, they watch an episode and they talk about other things, but they're just talking about, they're shooting the shit basically. And Donald Faison, who plays Turk in Scrubs, loves everything Star Wars. So every single week they're talking about the Mandalorian. So
makes good sense.
You're in good company.
Yeah.
With that, basically. What I was going to ask you about was the outsourcing thing you mentioned earlier. Mm-hmm. Do you think that the fund, it was kind of a prediction of what's 2021 and onwards going to look like? Are we going to see funds that are, outsourced to the max? Are we going to see funds that don't have an office? Or are we going to? How much are we going to go back to how we were before COVID, and how much are we going to be changed? Do you think?
I think. I think that the changes that were happening in the industry are continuing. I mean, they were happening before COVID, and this has just accelerated some of those changes in terms of outsourcing. And to be frank, fund managers need to focus on making money. That's their job, and finance and operations and those kinds of things. You need to have somebody internally who's responsible for those. But it's not really, it's not really part of their raison d'etre. That's, again, theirs is to make money, and to make sure that things are running properly by getting somebody else to help them out with it. Obviously, this sounds incredibly self-serving, but I do think to a great degree that's true. So I would say that'll continue through 2021, and that's the way forward.
You bought Eisner. You bought Eisner to the UK 2 years ago now?
Yeah, a little longer than that even. I think it'll be 3 years in February.
And you were the first man on the ground over here.
Yeah.
Breaking turf.
Yeah, I mean, look, we've been looking to come here for a long time, and it just made sense to come to this market because you're right, the firm it's very big in the US, and we've got offices around the world, but we didn't have anything in the UK and wanted to get something set up here because this is the second largest financial services center in the world, needed to have people on the ground. Clients were asking us in the States to have something here to help them in the UK. And then likewise, the number of UK fund managers that were looking for assistance in the US and with offshore, and we really, as an alternative to the Big Four, it's been great. I mean, the welcome has been great in the UK. I mean, obviously, I've been here for.
You were quite well set up here already.
Yeah, I'll say yonks because I know, having been here long enough, that that's a word you would use, which I'd never heard before. Yep. But anyway, and it's and it's been great, and the bringing a new brand to market here. It took a few months, but the uptake has been great, and we'll continue to grow the business here next year.
And you brought some team members over from the US.
Yeah,
as well?
we've got some people from the US and
Zach and Caitlin.
Yeah, Zach and Kate, and I mean, look, we've got audit and tax and anything you could want. It's really a cornucopia of
a sweet shop for alternatives.
Yeah.
Is that mainly Hedge, or is it you look at?
No, it's across. No, so I look after all of asset management. So it's Hedge, private equity, real estate, venture, and traditional asset management. And really, we are, after the Big Four, we're really one of the biggest in the financial services space. Full stop. We're just we just have a pretty heavy focus on financial services as a firm, and always have. We were, and this is one that I like to throw in. So the AYU Jones hedge, we were the first auditor to the AYU Jones hedge funds. We were really the very first hedge fund auditor ever.
Way back when?
Way back when?
1947?
Yeah,
something like that?
Something like that.
How's your history?
Yeah.
Your hedge fund history?
Let's go with that. Let's go with 47.
Put it out there. Someone check that.
Yeah.
Okay. And how about those guys in private equity real estate guys this year?
Private equity,
I think they've been swashbuckling.
Yeah, and private equity, I think, is just going to continue. It's really going to the flow of investment, I think, in private equity is really, it's going to dwarf Hedge. My background, I lived in the Cayman Islands for a number of years, and so I was very much a hedgy guy for a long time. But really, over the last couple of years, that business has expanded. My practice has expanded well beyond Hedge and across asset management. But private equity in particular has seen explosive growth, and there's so much interest from investors in private equity right now, and there's so much opportunity in private equity.
Yeah.
And I'd say private equity and private debt. Private credit to some degree. Private debt, though, I think private equity and private debt are just going to explode.
We've been kind of bringing that private debt silo underneath the hedge fund umbrella, like a little bit here and there. Are you seeing that? Are you separating those categories now? Or the lines between all these silos are very blurred anyway.
They are. I think people in private debt would like to separate themselves from Hedge. I think somehow but all of these. All of these fit into as an investor. I think they all fit into a broad portfolio of investments, and really it's sort of strategy and sector less than Hedge as an asset class or private debt as an asset class or anything else. It's really the underlying strategies that are most important when you're looking at a portfolio, and I think that's how. So there is a blend, and hedge fund doing what they would have historically said is hedge, long short equity or something like that, right? And they're providing private equity like investments now, and similarly private equity are providing hedge like investments, and so there's been this merger blend of all of those kinds of asset management styles, and so for an investor, I think now again it's strategy and sector that you're looking at rather than hedge or private equity or venture as an asset class.
Yeah, those lines are
blurred.
So blurred, and the term hedge doesn't even mean anything.
It doesn't mean
right?
No, and it hasn't meant anything for a very long time.
Very long time. absolute gets a bit closer, but that still doesn't really.
It does, and I think that's one of the it's one of the problems that Hedge has is everybody will sort of throw in, well, I'm going to compare a hedge fund product to the S&P 500 and the performance thing. Well, that doesn't work. That's not that's not a reasonable comparison. And
it's also not. It's always been a bugbear of mine that performance statistics are lumped together, and when we take a mean average out of 15,000 funds around the world performing, and then you say, well, hedge funds have done really badly this year. Well, that's the whole point of fund pickers and allocators is to pick the good ones, and the good ones are in there.
And look, if we knew what was going to happen in the stock market, that things are going to go like this, well, sure, I'd be 100% invested in the S&P 500 too. I mean, that's a no-brainer. Yeah. But you can't know that, and that's not what you're trying to accomplish. You're trying to accomplish something balanced, or you're trying to accomplish some other specific goals, and you need to allocate based on those goals. And so, I do think that, and I heard Jack Inglis from AIMA talking about this. There needs to be an education for there needs to be a continuing of the education of investors as to allocations and investment. And I think that's absolutely right.
There's a full spectrum of the depth of which people are going to really understand everything there. You've got some incredibly sophisticated right at the top, and then some
less sophisticated,
at the bottom, and we're now seeing a lot with our family office guys who previously weren't that into hedge, and we've definitely seen this year the family office appetite for hedge increase, albeit blue chip hedge, right? Very like brand name recognition. Certainly the Goldman Sachs family office team that we're quite close with have talked about family offices being much more into hedge funds this year than they have been previously.
I was talking this morning to the CEO of a very large Swedish pension fund, and we're talking about their allocation across hedge and private equity. I mean, they're doing quite a lot of direct investment. At a certain size, it's for pension funds or sovereigns, it's a lot about direct investment rather than investment with a GP. But he was saying that they've been, generally speaking, disappointed with hedge as an asset class, and and that the fees don't seem to justify the returns. And again, I think, and this is a large, sophisticated investor, and I still think though that there's a bit of a mismatch in expectations there, where you need to consider not hedge. You need to consider relative value, or quant, systemic. There are all kinds of ways of parsing the different investments within hedge, and I think those fit into different buckets. And I think that's a better way to look at it. And so across the board, from investors, sort of person on the street investors, and because you're increasingly seeing access to to liquid alternatives, right, and an increase in the ability to invest directly as a retail investor into alternatives. And I don't think that that's a bad thing.
You mentioned Cayman earlier, and it's gone blacklist off and on and off this year. Do you think Cayman is probably the if you think hedge fund, you think offshore, that's probably the name that comes up first, or attached to the hedge fund industry. Do you think that blacklisting will leave a dent on?
No, I think I don't. It's there are good service providers. It's a solid jurisdiction, good court system, and everything else. It's a good place to do business, and I think it's unfortunate what happened, that they got put on the blacklist, but at least my understanding of it is it was sort of a quirk of the legislature and timings and those kinds of things, and it wasn't a particular, it wasn't that there was anything particularly wrong with Cayman that got them on the blacklist in the first place. So I'm not terribly worried about it, and if you talk to any of the new fund managers we're talking to now, it's not even raised.
I've had that conversation twice this week. It hasn't been a major issue.
Nobody's mentioned it, and so I think it's fine. Look, if I was setting up my hedge fund, I'd still be. I mean, genuinely, if I was setting up a hedge fund now, I'd still be doing entertainment. Yeah.
How long were you there for? How long did you live there?
3 years or so.
Still tanned.
Still tanned. Yeah. No, I never got a tan. This is as
That's
tan as I get. This is it.
The Mandalorian tan.
Yeah. That's it. I do wear the helmet around.
Just around town.
Yeah.
Walking. You don't want to get papped in.
No, that's right.
Berkeley Square. I'm going to buy you the helmet. Yeah.
Thanks. Appreciate that.
Fantastic.